Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Understanding Basic Financial Concepts. Understanding basic financial concepts is fundamental to developing a robust financial strategy in business. Grasping these concepts provides the foundation for making informed decisions that enhance profitability, ensure sustainability, and foster growth. At the core of financial strategy lies an understanding of financial statements, budgeting, forecasting, and the principles of risk and return. Financial statements are essential tools for evaluating a company's financial health. The three primary financial statements are the balance sheet, income statement, and cash flow statement. The balance sheet provides a snapshot of a company's assets, liabilities, and shareholders' equity at a specific point in time. Assets are what the company owns, liabilities are what it owes, and shareholders' equity represents the residual interest in the assets of the entity after deducting liabilities. The income statement, also known as the profit and loss statement, details the company's revenues and expenses over a period, culminating in net profit or loss. This statement helps stakeholders understand the company's operational efficiency. The cash flow statement categorizes cash inflows and outflows into operating, investing, and financing activities, providing insights into the liquidity and solvency of the business. Budgeting is another critical component of financial strategy. It involves creating a financial plan that allocates resources to various business activities, ensuring that the company can meet its objectives while maintaining control over its finances. Effective budgeting requires a detailed understanding of the company's revenue streams and cost structures. A well-prepared budget acts as a guide for financial decision-making, helping managers anticipate financial needs and constraints. For instance, a zero-based budgeting approach requires managers to justify every expense, starting from zero, which can lead to more efficient allocation of resources. Forecasting extends beyond budgeting by predicting future financial performance based on historical data, trends, and market conditions. It enables businesses to anticipate changes in revenue and expenses, allowing them to adjust their strategies proactively. Accurate forecasting requires the use of statistical tools and methodologies, such as regression analysis and time series analysis, to project future financial outcomes. A company that effectively forecasts its financial performance can better navigate economic uncertainties and capitalize on emerging opportunities. The principles of risk and return are central to financial strategy. Risk refers to the potential for financial loss, while return is the gain or profit derived from an investment. The relationship between risk and return is typically direct. Higher returns are usually associated with higher risks. Understanding this relationship is crucial for making investment decisions. Financial managers must evaluate the risk-return trade-off to balance potential gains against the likelihood of losses. Diversification is a common strategy to manage risk, as it involves spreading investments across different assets to reduce exposure to any single investment. For example, a business might diversify its portfolio by investing in a mix of stocks, bonds, and real estate to mitigate risk. One practical application of these concepts is in capital budgeting, the process of evaluating and selecting long-term investments that are in line with the company's strategic goals. Techniques such as net present value, internal rate of return, and payback period are used to assess the viability of potential projects. NPV calculates the present value of cash inflows and outflows associated with an investment, helping determine its profitability. IRR is the discount rate at which the NPV of an investment is zero, indicating the expected rate of return. The payback period measures the time required to recover the initial investment, providing a simple assessment of the investment's risk. Moreover, understanding financial ratios is essential for analyzing a company's performance. Financial ratios, such as liquidity ratios, profitability ratios, and leverage ratios, provide insights into different aspects of a company's operations. Liquidity ratios, like the current ratio and quick ratio, assess a company's ability to meet short-term obligations. Profitability ratios, such as the gross margin, operating margin, and return on equity, evaluate the company's ability to generate profit relative to sales, assets, and equity. Leverage ratios, including the debt-to-equity ratio and interest coverage ratio, measure the extent of a company's financial leverage and its ability to meet debt obligations. For instance, if a company has a current ratio of 1.5, it means that for every dollar of liability, it has $1.50 in assets, indicating good short-term financial health. Similarly, a high return on equity suggests that the company is effectively using its equity base to generate profits. On the other hand, a high debt-to-equity ratio may indicate that the company is heavily reliant on debt financing, which could be risky if interest rates rise or if the company faces financial difficulties. These financial concepts are not just theoretical, they have practical implications for business strategy. For example, during the 2008 financial crisis, many companies with high leverage ratios faced severe difficulties due to their inability to service debt amidst declining revenues. In contrast, companies with strong balance sheets and effective cash flow management were better positioned to weather the crisis and even capitalize on distressed assets. In addition to understanding these concepts, it is essential for business leaders to stay informed about the broader economic environment. Macroeconomic factors, such as inflation, interest rates, and exchange rates, can significantly impact a company's financial strategy. For instance, rising interest rates increase the cost of borrowing, which can affect capital budgeting decisions and overall financial performance. Similarly, fluctuations in exchange rates can impact companies involved in international trade, affecting their competitiveness and profitability. To illustrate, consider a US-based company that exports goods to Europe. If the euro depreciates against the dollar, the company's products become more expensive in the European market, potentially reducing sales. Conversely, if the euro appreciates, the company's products become cheaper, potentially boosting sales. Therefore, companies engaged in international trade must closely monitor exchange rate movements and consider using hedging strategies to mitigate foreign exchange risk. Ethical considerations also play a crucial role in financial strategy. Transparency, accountability, and integrity are essential for maintaining stakeholder trust and ensuring long-term success. Unethical financial practices, such as earnings manipulation or insider trading, can lead to significant legal and reputational consequences. For example, the Enron scandal in the early 2000s, where executives engaged in fraudulent accounting practices to hide the company's financial problems, resulted in the company's collapse and severe repercussions for those involved. In conclusion, understanding basic financial concepts is fundamental to developing effective financial strategies in business. Financial statements provide critical insights into a company's financial health, while budgeting and forecasting enable proactive management of financial resources. The principles of risk and return guide investment decisions, and financial ratios offer valuable performance metrics. By staying informed about macroeconomic factors and adhering to ethical standards, business leaders can make informed decisions that promote sustainability and growth. These concepts form the bedrock of financial strategy, empowering businesses to navigate challenges and seize opportunities in an ever-evolving economic landscape. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.